All right, my name's EJ Pulpan, Pulpan Brothers Group, Christie's International Real Estate Sereno. I'm here with Ron Ricard, IPX 1031. Today we're going to be walking through the 1031 exchange. This is a term that's thrown around a lot in our industry, but I don't think most people truly understand all the nuances that come with the 1031 exchange. So we're going to walk through some of them today, and then we'll open it up for questions if there are any. But Ron, thank you so much for being here. Wealth of knowledge. I was going through all week telling people that you were going to be sitting down with me, and you have quite the reputation in the industry. So thank you so much for giving me your time.
Thanks for having me.
And why don't we just start off with just a general overview of the definition of Section 1031 and what it is and why someone would consider doing one.
Okay, so 1031 is part of the tax code. It's part of the tax code that allows you to sell a piece of business or investment real estate. And as long as you buy another piece of business or investment real estate, you get to defer paying taxes on the profit that you've made. So you have a rental house, you're tired of it, you want to go buy a fourplex. So EJ lists the property, they find a buyer for the property. At the close of escrow, the money comes to a third party called the intermediary. That's what we are. And then Josh helps them find that fourplex they want to go buy in replacement. We send the money to the title company on that side, and the property closes. So in the eyes of the IRS, they sold a piece of investment real estate, and they bought a piece of investment real estate. And because they didn't touch the money, because we had it, they get to defer paying taxes on the profit that they've made.
Got it. And so you being a IPX 1031, being a qualified intermediary, when someone's considering this, when are you introduced to the exchange? When do you step in? Just so that people can understand, like, if they are thinking about it, is it something that happens before they sell the relinquished property? Just kind of elaborate on when you usually get introduced to the process.
There are two answers to that. The first answer, mechanically speaking, in terms of when do we actually start the paperwork and things, only happens once you're actually in contract with a buyer. Now, we have to be involved before escrow closes, but as long as there's a contract, then we can do the paperwork for the 1031. But from a more holistic point of view, I like to talk to the clients even before the property is listed. It's not uncommon for me to talk to owners before they even list the property or even they're thinking of listing the property. Basically, so they're comfortable with the rules, the process, the timelines. That way, once you find them a buyer for their property, we can start the paperwork very easily. But I'm happy to get involved at any point, but we do need to be involved before escrow actually closes.
And I think that's a huge value add from your business standpoint, because to educate the parties on really what goes on here, because once that timeline starts and once the clock starts moving, it can get stressful.
Absolutely. As we're going to talk about in a few minutes, once escrow closes, you only have 45 days to find what you're going to buy. And I always not jokingly say they are the fastest 45 days of your life.
Absolutely. Absolutely. So let's, you talked about exchanging one investment property for another investment property. And I think that's a good way to put it. But another term that's thrown around often is like-kind property. Can you kind of debunk this term like-kind property and what I mean by that is, if you own a single family home and you're looking to optimize your portfolio, you may be considering a different asset class.
Right. So the term like-kind dates back to when we used to do exchanges for things other than real estate. In my 20 plus years of doing this, I've done exchanges for airplanes. I've done exchanges for artwork. I've done exchanges for farm equipment. So that's what like kind meant. If you sell a boat, you have to buy a boat. If you sell a airplane, you have to buy an airplane. If you sell farm equipment, you have to sell farm equipment. My favorite exchange I ever did is I did an exchange for a gentleman who sold a FedEx delivery route in San Jose and went to Sacramento and bought a UPS delivery route. That's what like kind meant. But as of 2017, the last big tax rewrite we had, Congress completely eliminated all 1031 exchanges except for real estate. So the term like kind is a bit misleading now. Excuse me. Like kind is any kind of business or investment real estate for any other kind. So you could sell a rental house and buy a shopping center. You could sell a farm and buy an apartment building. You could even sell bare land and buy a rental condo. Any kind of investment real estate for any other kind. You could also buy multiple properties. You can sell one, buy multiple. You can sell multiple to buy one. All of that's okay, but it's any investment real estate for any other. Yes, that term like kind makes it sound like if I sell a yellow house on a street corner, I have to buy another yellow house on a street corner. No, that's not the case. Any investment real estate for any other kind, anywhere in the country.
Yeah. And so let's back up for a second just to make sure that anyone that's following along understands. So we live in the Bay Area, and over the last, let's say, 30, 35 years, we've seen an incredible boom in appreciation. And a lot of people have been here for that entire cycle. So they've acquired a large amount of equity through the appreciation of their property. And if they were to go out and just sell the property outright, that Section 121, $250 for a single, $500 for a married couple, probably would not cover the appreciation of this property from to remove the tax consequence of selling such property. So they may consider looking into this vehicle 1031 exchange to help navigate that tax consequence.
So first thing to note there that you're talking about people's primary residences,
yes.
not necessarily their investment property. Hopefully they have investment property that has gone up as well. But primary residences, yes. When that $250,000, $500,000 exclusion was put in, that was in 1997. That was a lot of money, even for the Bay Area. But since then, obviously, prices have gone up so much that nowadays many people, when they sell their primary residence, have a gain way more than that exemption.
And the reason I bring it up is because what I've seen in my experience is that the homeowners of these single-family residents that were primary residents, they recognize the tax consequence that they have. So they feel trapped because of that that consequence. So they go ahead and they rent the property out because they don't want to sell. But by doing that, they're actually walking into the first step needed to open up this door, which is the 1031 window, because once the property's been transitioned from a primary residence to an investment property, they now can use this vehicle. And in our area, it's a great example just because, we have seen so much appreciation. There's been so much boom, and a lot of people, they're stepping into a different phase of their life, and they may be looking for, to optimize their portfolio to fit more of their current needs versus what they were looking for 10, 15, 20 years ago. Great. So 1031 exchange outside of just moving one asset, can you walk into, or at least elaborate on the 45 days that you had mentioned and kind of the timelines associated? Because I think these are the hurdles that people need to be aware of.
Right. There are two important areas, two important rules that we need to know about when we're doing an exchange. First is the timeline, and the second is how much to spend. And I would say most clients have a very serious misunderstanding of some of those. So the main thing when it comes to the timeline is from the day you close escrow, you have to know what you're going to buy within 45 days. Now you have 180 days, which is almost 6 months, to close the escrow, but you need to identify what you are going to buy by the end of the 45 days. Now, when we say identify, what do we mean? Well, technically it means you give us a piece of paper with an address on there. Now, you can identify multiple properties. Most people who are only going to buy one or two would identify a maximum of 3 properties. If their goal is to buy more than 3, then there's what's called the 200% rule that allows them to identify more than 3 properties up to a dollar limit of 2 times or 200% of the sales price of the property sold. But focusing on just the general identification. Identification means you're giving us the address to the property you're going to buy. Now, technically speaking, you're only giving us the address to the property. So I always get the question, do you have to be in contract by that 45 days? Technically speaking, no. You just give us the address. But if on day 46, all 3 of those properties get sold to somebody else, then you're screwed. I mean, the reality is you need to be in contract inspections done, loan approved. I mean, you want to be locked into a property by the time you get to the 45 days. The last thing you want is to find that the house is being held together with termites holding hands or something where you just don't want the property after day 45. So really by day 45, you want to be locked in on what you're going to purchase. And I would say most of my clients are actually done with their exchange by the 45 days.
Got it. And then second timeline?
Second, not the timeline of the 180 days to close the escrow. So you need to close the escrow within 180 days. Unless you're buying new construction, though, that 180 days is usually not an issue. One thing to remember is when Congress established these laws, these timelines, they were focusing on mostly commercial real estate, which has much longer escrows. But when it comes to residential, for most of us, if you have a property in or close to being in contract by day 45, chances are by day 90, you're going to be done with your exchange. So again, new construction, yes, that might go to the full 180, but that's not nearly as important as the 45 days when you're considering doing the exchange.
Yeah, and as you mentioned earlier, those 45 days are they're nerve-wracking.
They can be.
Yeah, and one of the things we do on our end is typically in this area, we work in a seller's market, right? So the sellers do have a little bit more negotiation power when they're working with the buyer. And what we do is we typically work in a longer close of escrow. We remove the contingencies, but we work a longer close of escrow to kind of buy us some additional time before we start that 45-day clock, because it, really every day matters. And especially when we're going out of state, right? Because there's a lot of due diligence. There could be travel involved. So we really try to make that as easy as possible. But at the end of the day, that IRS lays the 45 days.
I'm just going to interrupt you. I've got a question on the call that asks, are you limited to California? You're kind of touching on it right now, but I just wanted to specify that somebody's asked that question.
That's a great question. The answer is 1031 is federal law, and you can go anywhere in the country. So you can sell in California, buy in any other state, or vice versa, and you are still deferring both state and federal taxes, even if you buy outside of California. Now, I will say there is a tax reporting requirement that you need to know about to California, but as far as just paying the taxes, yes, you can go anywhere in the country, anywhere within the United States or most of its territories, and to sell and to buy, no problem.
Perfect. And let's go back to the qualified intermediary for a second. What should somebody look for in their QI?
Well, the first thing to realize about what we do as an industry is that we are not regulated. They're very, very, very lightly regulated. And so there is nothing to stop you from starting EJ's exchange company tomorrow. As long as you can post a $250,000 bond, you can work as an intermediary. So there's very little regulation. And because of that, there have been some issues with clients not working with intermediaries that are 100% on the up and up. So I do recommend, if you're working with an intermediary, please work with the big companies. Typically, the large companies are the ones that are backed by the title companies like Chicago Title, Fidelity Title, First American Title. They almost all have a large exchange company, and so they're backed by a very large corporation. Lots of insurance, lots of bonding. In today's market, I'm not really worried about theft by the intermediary. What I'm really worried about is wire fraud, because we are very much targets of wire fraud, of people trying to have us wire money to the wrong bank account. And fortunately, we have a very strict protocol that we follow. But if somehow we actually did end up sending somebody's money to the wrong place, we have a big parent corporation who steps in and makes good on that money. And small companies just don't have that. I mean, for the small cost it is for doing an exchange, it's not worth saving $100 just to make sure and have your money not be safe.
Got it. And so I guess the moral is lean in, place the phone calls, have those conversations, do your due diligence, understand who you're doing business with, and take into account that, the proceeds from the sale will be moving through this intermediary. Right. They will be touching the money, because as soon as you touch it, taxable expense. So
exactly.
Important. Now, you mentioned there the fees associated with doing an exchange. I do think that there's a stigma around, anything that has to do with taxes, deferring taxes, things like this, that it's a wealthy man's game. It's things that, only the wealthy can take advantage of. Can you kind of shine some light on the fees associated with doing a 1031 exchange?
Yeah, that's a really common thing. People think 1031s are very complicated, very expensive, and it's only for rich man's game, and that's absolutely not the case at all. The cost of a 1031 itself is very small. It's $1,000 when you sell the property, and $250 for each additional property bought or sold as part of the same transaction. So if you sell one, buy one, $1,250, and so it's a very small fee. And I would say that more than half of my clients are selling properties that are worth less than $500,000. So it's not uncommon for me to be working with people in markets like the Central Valley or in other states where we're selling $150,000, $200,000, $300,000 properties. I did an exchange once for a guy who sold a piece of land in the Santa Cruz Hills for $25,000. He preferred to pay me $1,000 than to pay the government $4,000. I'll take it. So it is not just for big transactions. Any kind of investment real estate, if you're saving more than $1,000 in taxes, it's worth looking into doing one.
Great. And then so you've been in your years, I'm sure you have story after story, but I'd love to just kind of get an understanding as some of the things that you've seen repeatedly, pitfalls that people have fallen into or failed to do that have caused some hardship, so that we can at least share with anybody that's watching this, what they should look out for and what they should do to prevent this happening to themselves.
Well, I'm going to answer that in two different ways. I mean, the biggest misunderstanding people have when it comes to exchanges is how much they need to spend when it comes to the replacement property. I would say that more than half the people that call me have this wrong. You need to buy equal or greater to what you sell the property for, not the equity, not the profit, everything. So if the property sells for $1 million, you need to go buy for at least $1 million. Now, you can buy more than $1 million. You can buy multiple properties that add up to $1 million. But if you buy for less than $1 million, you pay tax on the difference. That difference is referred to as boot. Boot is what you pay tax on, but you need to buy equal or greater to what you sell for. And that is probably the biggest misunderstanding in someone where they think they only need to use the equity or only the profit. And that's absolutely not the case, because if you don't replace the debt that was on the property, then you're going to have a taxable consequence. And you can replace the debt either with another loan or with cash from your pocket, but you do need to replace the value of that debt.
So get a new loan on the acquired property, the upleg, or bring cash to the exchange and do that greater than or equal to.
Right. So that ultimately you're looking at the sales price of the property. That's what your target is when you're buying the next one. Exactly.
Great. The other thing that I've seen is I'll get phone calls from people that have already closed.
I got one of those this morning, believe it or not. They closed escrow 3 days ago and got the money. Now they want to do an exchange. Too late. The exchange has to be set up before escrow closes, because the escrow officer has to know that the money is going to come to us, not to the seller. So
I'm going to just chime in there, EJ, and say that I think sometimes that's the fault of the real estate agent who doesn't fully understand the rules of the exchange.
Educate up front, make sure that does not happen, because as Ron mentioned, there's no going back once you've touched it.
Exactly.
Can you so when this is going to get complicated real quick, but we'll try to do a very simplistic version of it. But when you're deferring the gains from one property to another property, you have your cost basis, and then you have the sales price, and then that's typically the amount in which you're going to pay, if you hold the property for over a year, long-term capital gains. But you also have the depreciation component. Can you kind of walk through what that looks like once the exchange has been completed?
All right. So, rewording a little bit what you said, ultimately you pay tax on the gain, and the gain is the difference between what you sell the property for and what your current basis is. And that basis is your purchase price plus whatever capital improvements you made on the property. But also, as an investment property, that property gets depreciated every year. So that basis goes down every year because of depreciation. And if you ever sell the property and just cash out, now you're going to pay tax. You're going to pay capital gain tax on the gain of the gain you have in the property, but you will also pay what's called depreciation recapture tax on the depreciation that was taken. Now, when you do an exchange, as long as you're buying equal or greater, you are deferring both of those taxes, both the capital gain and the depreciation recapture. Now, when you do the exchange into the next property, your basis rolls over into the next property. So whatever your current basis is, that becomes the initial dollars into the next property. Now, if you buy something more expensive, the basis will go up, so that effectively your current gain, your current taxable bogey in your current property, that just gets rolled over into the next property. If you're buying multiple property, then those dollars get prorated among the properties that you purchase. But ultimately, though, yes, if you cash out, now you're going to pay tax on both the capital gain and the depreciation recapture.
Got it. And so the clock doesn't restart once you acquire that new property on the depreciation
That's
schedule.
correct. Yeah, you can't sell $1 million house, buy another $1 million house next door, and you don't get brand new depreciation. You only get what's left of the existing depreciation. Now, if you sell for $1 million and buy for $1.2 million, now you have $200,000 of new investment. Now you get new depreciation. But you do not reset the depreciation just because you do an exchange. No.
Got it. And so up until this point, we've talked primarily about just a standard exchange, but there are reverse exchanges, construction improvement exchanges. Can you kind of just touch on both of those?
Yeah. So both of those are referred to as parking transactions. But think of it. Let's talk about a reverse exchange first. A reverse exchange is exactly what it sounds like. You are buying something and then selling yours. Now, note, it does not matter when you go into contract. If you go into contract to buy something, but they're willing to wait until you sell your property, then it's still a regular exchange because you're able to close escrow on what you're selling first. But if you do need to close escrow on what you're buying first, there are different ways of structuring them, but the most common way of structuring them is you come into escrow with the money to buy that property, but we take title to the property. Because if you buy the property, you now own both. And you can't do an exchange into a property if you already own it. So you come into escrow with the money to buy that property. We take title to that property in an LLC that we create. Then you have 6 months to sell your property. Once you sell your property, then that's when the actual exchange takes place. You sold your investment property. Now you acquire this one from us as the replacement. So we are effectively a placeholder on title for you. Biggest issue about this, it's a bit more expensive, a bit more complicated, but the biggest issue is the financing, because conventional lenders for residential real estate typically do not participate in this kind of an exchange because they don't want to lend you the money and have us on title to the property. So if you have the cash to do it, then it's really easy, or have access to the cash. If you need to get a loan, you're probably going to get some kind of bridge or short-term financing to get it done. But right now in today's market, as we talked about a little bit earlier, there is not a lot of inventory. So right now we are doing a ton of reverse exchanges because people are just afraid of not being able to find a property because of the lack of inventory during that 45-day window. So because of that, for those clients who have the means, reverse exchanges are, in some cases, actually the preferred way to go.
Mm-hmm. Takes a little pressure off.
Takes a lot of pressure off.
That
Exactly.
you've already secured that replacement. And then especially in a market like this, 6 months is plenty time
to sell your property.
To sell a property out
Exactly,
here.
yeah.
And then for the improvement exchange, so let's just use an example of when this would come in, and then I'll turn it over to you. Value add property. You go ahead and you sell your relinquished property, move the funds, acquire the replacement property, but the property needs work, and the property was less than the amount that you sold the relinquished property for. Mm-hmm. And then you'd go into the QI again, holds title.
Okay. So the question that I always get asked is, can I make improvements to the property after I've bought it? Mm-hmm. And the answer is technically no. The day you take title to the property, the day you buy the property, that's the end of the exchange. If you haven't used all the money, you're paying taxes, even if you do the improvements. But the key is that's because you took title to the property. So in an improvement or build to suit, or sometimes called a construction exchange, what's happening is we take title to the property. So you sold your relinquished property. We're holding your funds. We then will go ahead and buy that next property again in an LLC that we create. And while we are on title to the property, we then pay your contractor to do the improvements on the property. Now, once you've spent the money that you need to satisfy the exchange, then we just give the property to you, and that finishes the exchange. So you've sold something at one price, we bought the property, did the improvements, and then sell you that property at that equal price. The biggest issue here for these improvement exchanges is that you're still bound by the same 180-day rule as a regular exchange. So you're not going to build a brand new house in 180 days. You need to get permits, plans, etc. So typically, this is done when you're looking at remodels, tenant improvement work for when it comes to commercial real estate. I'm doing one right now for a woman who's putting in a pool at her house. But yes, you can do improvements to the property that way.
Got it. And when you look at in your experiences, like is there anything that you reflect on in terms of like a success story or something that stands out to you in your past experiences working with people on 1031 exchanges is like, wow, that was pretty special?
You mean in terms of an improvement exchange or just exchange in general?
I mean, I love the idea of an improvement exchange, but if there's one that stands out on the other side, I'm open to that too.
I literally have been involved in over 22,000 exchanges over the years. So there've been numerous ones that were pretty special. I don't know. I think I go back to my very first improvement exchange. The guy was sold a piece of real estate here in the Bay Area. He was moving to Washington and planted 40 acres of Christmas trees for his improvement.
Wow. So once he acquired the land,
Yep.
he was also able to put the Christmas trees.
Yep. So we bought the land. He brought all the trees out there and planted 40,000 Christmas trees over I forget how many acres it was. So that was kind of a fun one.
Yeah,
And that satisfied the exchange, yes?
That's why the exchange, exactly, because the trees are viewed as improvements to the property.
I love it. I think one for me and one of the main reasons I wanted to do this was because I think it's just so relevant to so many people is that the transition from, again, a primary residence to an investment property to a larger investment vehicle that sets up passive cash flow.
Oh, absolutely.
So that, they can set up a retirement that way. I mean, you can transition the house that you raised your kids in into your passive income throughout your retirement using this vehicle. Now it's going to take some time, but once done, I mean, it truly is a special thing to see people make that transition and create the life that they're looking for out of their real estate portfolio.
Let me give you a real life example on exactly that situation. A few years ago, I was dealing with a couple. They had bought their house in Los Altos Hills for $35,000. It was now worth, in round numbers, $3.5 million. And their goal was to move to Southern Oregon. So they borrowed $500,000 against the house, and then bought their house in Southern Oregon. Now they converted their house into a rental property for about 18 months. Their accountant said close enough. They sold the property, they were able to pocket $500,000 because remember, as long as you live within the property 2 of the last 5 years, you can actually take advantage of both tax rules at the same time. So they were able to pocket $500,000, take the other $3 million, and in their case, they bought I forget if it was a Jack in the Box or McDonald's in Los Angeles. So literally, they were looking at an $800,000 tax bill if they just sold the property. But instead of paying $800,000 in taxes, they were able to put $500,000 in their pocket, have the house of their dream, and buy an asset that was generating $10,000 a month in net income. Winner.
So Ron, that example is perfect because I've heard that, but I haven't actually addressed that with a professional like yourself. So that's taking advantage of what I was discussing earlier, Section 121, and then also leveraging the exchange vehicle into an investment property.
That's correct. First thing, we kind of skirted around this, so I want to make sure people are clear. A primary residence does not qualify for 1031. If you just have a primary residence in and of itself, it does not qualify. Now, it is possible for property to be an investment and a primary at the same time. Let's say you have an ADU or you rent out the basement. Maybe you're self-employed like a lot of realtors are, and you have a home office that you're declaring a percentage of your house's home office. So if you already are in a property that is a dual-use property, then whatever percentage of the property you are declaring to the IRS as the investment portion, you can do an exchange on that percentage of the sales price. So it is possible for a property to be both at the same time. But most of us, like myself, I don't have a home office. I don't have an ADU. So if I don't want to pay taxes, then I would need to convert my property into being an investment property and follow the rules as we just talked about.
But in the example that you just shared, they rented the entire property out for 18
Yes,
months?
yeah. In this case, they moved out. They moved to their brand new house in Oregon and rented out their old house in Los Altos Hills for 18 months before they sold it. Now we say 18 months. The tax code nor IRS give us a specific amount of time and it needs to be rented out. Some accountants like to see 2 years. Some are a little more aggressive. I always say this is something you need to discuss with your own tax professional, but usually 1 to 2 years as a rental is what most of them are going to look for.
I love that, Ron. Any advice that you have for real estate agents that are conducting these?
I always tell newer agents, if someone comes to you and they want to do an exchange, my first words of wisdom are, don't panic. On the listing side, there's very little actually for the real estate agent to do. I always say the most important thing an agent needs to do if a client's doing an exchange is to make sure their client understands the rules and they are educated about the 1031. You do not need to know anything about the 1031. That's not your job. That's why you have someone like me help your clients. But ultimately, make sure the client knows what they're doing. But everything else about your listing of the property is exactly the same. Same tour, same purchase contract, same listing agreement, same open houses. Everything is exactly the same title company. Most of the work that we do as the intermediary is done with the title company and the client directly. We have very little actual interaction with the realtor in most cases.
Got it. The only other thing I can add to that is you do need to disclose to the buyer that the seller is completing.
Right, you do need to disclose. Correct.
I was going to add, just make sure also that the seller does not realize those funds, that the seller does not take those funds into their possession. Make sure that the 1031 exchange company, make sure you've got somebody like Ron Ricard in early enough and working with the title company to make sure that those sellers don't touch those funds.
I kind of summarize that as make sure the client knows what they're doing, disclose it to the buyer, and please call me before escrow closes. Because as long as you've done that, that's really all the realtor has to do.
I love it. Any questions on there, Brian, or are we good?
We are good. Everybody seems to be satisfied. You guys, I think, had an amazing conversation. I mean, Ron, of course, 20 plus years in the business, and how many 20 plus 1,000 transactions?
Oh my gosh.
So everybody should be paying close attention.
I love it. Ron, thank you so much for sitting down, having the conversation. Really appreciate it.
Thank you for having me, and good luck in your business.
Awesome.